But we begin with the new federal mortgage rules that kick in today. They are designed to cool Canada's hot red housing markets, especially those in Toronto and Vancouver. And they're making it harder for some people to get a mortgage. The new protocol forces first-time homeowners to pass a so-called stress test. In other words, those who don't have a 20% down payment, they must be able to prove that they could service their loan if interest rates were to rise or their personal finances change. Here's an example. Interest rates are currently at an historic low. With some shopping around, a would-be buyer could find a 5-year fixed mortgage with a rate around 2.39%. But under the new rules, borrowers would be required to qualify at the Bank of Canada's benchmark rate, currently 4.64%, a big difference for purchasing power. And just as the new stress tests for Canadians who want mortgages take effect today, the Canada Mortgage and Housing Corporation is ringing the alarm over the country's real estate sector, saying it's planning to increase its risk rating of Canada's overall residential real estate market from moderate to strong. So what does that mean for would-be buyers? Personal stories are already trickling in. Take Toronto's Kevin Thorne, who had hoped to buy the condo that he currently rents with his wife. Just last week, the couple qualified for a $400,000 mortgage. But under the tough new mortgage rules, lenders say that they can only afford to carry a mortgage of $340,000, which means that condo, it's now out of reach.
You can only buy what's out there. And, you know, I have a stable job and income. My wife now has a stable job and income. So for the two of us combined to not be able to crack anything in the Toronto market says a lot about the livability in the city. We may have been priced out of owning anything that's really in the city because, you know, not a lot of condos are going less than $400,000.
CBC's Peter Armstrong is the host of On the Money, and he joins us on this hour now to talk more about these new mortgage rules and real estate in general. Peter, we just heard how this is impacting one buyer in the hot market of Toronto, but let's talk about the wider impact here.
And it's pretty widespread. And I mean, if you crunch the numbers, sure, it's going to have an impact in the hot markets, but that same impact, that same sort of, you know, limiting of people and their ability to get into the market is going to happen in areas where the housing market is cool. Then the impact that that's going to have on the national picture is going to be interesting. The people at Rate Hub, which is a group of mortgage brokers across the country, they crunched the numbers and said somebody who previously qualified, who on Friday qualified for a $650,000 mortgage under these new rules will qualify for about a $500,000 mortgage. So $150,000 difference, about 20% difference in terms of their purchasing power. So think about all those people that have spent years, frankly, saving up to try to get money to get into the market. They were waiting and ready, didn't close in time or didn't find the right place, are now priced back out of the market again. And that has one impact in Vancouver. It has another impact here in Toronto. But imagine the impact that has in Prince George or in Windsor or in, you know, Quebec City. It's very different there, and it gets to that point where trying to find national strategy to deal with several different housing markets and several different problems that exist within them becomes a little bit problematic. So the impact of this is going to be widespread, and it'll be really interesting to see as we get that data what is actually happening.
And as well, the CMHC has they raised their risk assessment from moderate to strong. They're using the term a red alert. So what exactly does that mean?
Well, they're saying it means that we need to be really careful. We need to be very aware. We're going to parse this statement inside and out 150,000 different ways before they actually issue the red alert, because we're not actually there yet. They say they're going to issue this red alert. And a lot of people are going to say we're right on the edge of correlation is not causation. They're saying that high indebtedness and high housing prices are often followed by a downturn in the economy. But fundamentally, Sarah, it means smart people with access to a ton of data are saying, you know what, we're a little bit concerned. We need to be aware, and we need to watch what the government is doing as they sort of start to tap on the brakes a little bit and get a better sense of what's going on in the housing market and what impact these new regulations are going to have as they sort of kick in.
CBC's host of On the Money, Peter Armstrong, thanks so much.
You bet.